We continue with partnership. Very important terminology that you need to know is the primary and the secondary distribution. In the example of Sing Song stores, there are two steps involved in the appropriating of the net income of 120 to the partners. So when we share, remember we said the interest on capital and the salaries to the partners is part of a fair split of the profit. So there was two steps here. The first step was now to deduct the partners' salaries, Sing 15 and Song 30, and the interest on capital, a total of 60,000, from the net profit. So the total of the partners' salaries and interest on capital in this example is 105,000. So we have first subtracted 105,000 from the 120, which is now our net profit, transferred to the appropriation account from the profit and loss account. These are the first amounts that are credited to the partners' current accounts. And these are called the primary distribution. That is what is paid out of the net profits first. Before we do the profit sharing ratio, that is what is paid out of the profit. So what is the primary distribution? It is the partner salaries plus interest on capital, and if there's any bonuses paid to partners, it's included here, plus the bonuses paid to partners, is equal then to the primary distribution. Now what was step number 2? To divide the 15,000, where did we get the 15,000? It's the 120, which was our net profit, minus the 5,000 rand, which was the primary distribution. The salaries and the interest on capital gave us 15,000, and we called that the remaining profit. So we divided the remaining profit, 15,000, between the partners in accordance with a profit sharing ratio 1:1. So 7,500 was therefore credited to the current accounts of each partner. And this is termed the secondary distribution. This happens after the primary distribution. So we first pay out the salaries and the interest on capital, and that is the primary distribution. That gives us then the remaining profit, which we share according to the profit sharing ratio, and that is then the secondary. So what is the secondary distribution? If we take out our net profit minus our primary distribution, which is what? The salaries paid to the partners plus the interest on capital paid to them. That gives us the remaining profit or loss, and that is then shared according to the profit sharing ratio, and we call this the secondary distribution, or also known as the final distribution. Then it's also possible for the partners' current accounts to have a debit balance. So all the closing transfers has taken place. What is the closing transfers? Is when we have split the profit in appropriation account and transferred that there together with the adjustments where we have debited the salary accounts and credited the current accounts. The reasons for this could be that there was a net loss made. Remember, when we made a profit, we will debit the profit and loss account and we will credit the appropriation account. That is, then we have our primary distribution and then our secondary distribution, and our current accounts are credited. But if a net loss was made, it means we will debit the appropriation account with the net profit and credit the profit and loss account. And to transfer the net loss will be then to credit the appropriation account and debit the current accounts. So that can now result in a debit balance in the current accounts. Or the partners' drawings have exceeded their salary allowance, their interest on capital, and their share of the remaining profit. Now, the salary allowance, the interest on capital, and the share of the remaining profit is what the partner has earned. Now, if what he has withdrawn out of the business is more than what he has earned, it can result in a debit balance. The debit balance may be regarded as an amount that is now owed by the partner to the business. Debit balance is then carried forward to the next accounting period where the position should be rectified, either by making sure profit is earned or by decreasing the drawings. Now, it is also possible for a business to make a remaining loss. Now, this is totally different than a net loss. A net loss is when the expenses in the profit and loss account is more than the income in the profit and loss account, and it then is a loss that is transferred to the debit side of the appropriation. That is what a net profit is. A net loss is. Remaining loss is something different. It is possible that the business could earn a net income. So we have made a profit. The business did make a profit, but yet there could still be a remaining loss instead of a remaining profit. How did we get to a remaining profit? It is the net profit minus the salaries and the interest on capital. In other words, the net profit minus the primary distribution. It gave us the remaining profit, which was then shared according to the profit sharing ratio. Now, a remaining loss will occur when the net income, the profit that the business made, is not as high as that they had expected and is exceeded by the primary distribution, meaning that salaries of the partners and the interest on capital of the partners is more than the profit that the business actually made. And that then leads to a remaining loss that needs to be shared according to the profit sharing ratio. So let's look at the appropriation account. So we have made a profit, we have debited the profit and loss account, and we will credit the appropriation account. So we've made a profit of 100,000. First paid out of the 100,000 needs to be the primary distribution, which is the salary of each partner and the interest on capital. Okay, so the profit that we've made is 100. The salaries and the interest on capital, which is the primary distribution, adds up to 120. So the primary distribution is 20,000 Rand more than the profit that we have made if we take the balance method. The debit side is 20,000 Rand more than the credit side. It has resulted in a remaining loss, which will then be shared according to the profit sharing ratio. So the appropriation account will be credited with the current accounts of the partners, and the partners' current accounts will be debited.